Everyone calls these stocks safe, buy and hold forever, but when you actually stress test them, most of them aren't as safe as you think. Daniel has done hour-long deep dives on every stock on this list on the Investors Podcast Network. Today, we're going to go through 15 of them, S tier to D tier. We don't agree on all of them. If you're new here, I'm Varun. I sold my startup to Google, and I view investing from the business owner's mindset. We're going to start with the greatest buy and hold stock of all time, Berkshire Hathaway. We're going to look through all of these through three things. The moat. How strong is it today? Can it survive the next 10 years? The reinvestment runway and leadership. Do we trust them? We're also going to talk about valuation. Daniel, start with your thoughts on Berkshire Hathaway.
Berkshire Hathaway is a company that, of course, every value investor knows. As you know, on our show, we build a portfolio of the companies that we think are the best position for the next, let's say, 10 years. Berkshire Hathaway is also in that portfolio, although it is somewhat of a cash proxy. So whenever we find a better opportunity, we're likely going to sell some of it and reallocate it to other positions. Yeah, I mean, Berkshire Hathaway is so well known. You just mentioned key man risk. I feel like if there's one company where you could have talked about that for a long time, it was probably Berkshire. Now, Buffett is gone and you have Greg Abel. That is a big question in terms of how will he lead the company. I feel like he's more of an operator, whereas Buffett was more like, an investor, knowing where to invest money, putting money to work. And so it's what do you get with Greg Abel? That's a question there. But to me, it's still one of the highest quality companies out there. I mean, you're talking about businesses that they own that just can't be replicated. You have BNSF, you have the energy business, you have the insurance business, which is giving them about, I think, $160 billion in float every single year. So yeah, you have a lot of like businesses that can't be replicated. And of course, you also have one of the best capital allocators making decisions there for a long time. And I don't think that changes because they still have a huge team that source ideas. So I would say it's one of the highest quality companies already that we have on the list here today. I don't know if you immediately want to go into the ratings. I can obviously say that it's high up on the list for me.
We can talk through like how do you think about each of these three, like the moat, maybe the reinvestment
Yeah.
runway, and then where leadership is right now. And then we can put it in a tier once we've talked through all three of those.
Yeah, I feel like the biggest question is probably number two, right? In terms of the run rate for Berkshire Hathaway. I think they're currently sitting on over $300 billion of cash. So you definitely have, scale disadvantages in terms of what investment would still need or move the needle. And I do think there's not too much. I think Berkshire is probably only waiting for a market downturn, then investing a lot of that money. And personally, as an investor, I view this as more of a mature company where I don't see a lot of outperformance in the next 10 years because, again, what is supposed to move the needle for them? They only can look for, let's say, the 50 biggest companies in the US to actually invest a lot of that money. And you can mostly do that when the stock market is going down. So on that end, I don't think it's too attractive. If you then ask me about the leadership and the quality of the businesses that it owns, and that's kind of the moat, right? I feel like the moat is pretty much untouchable. So for me, Berkshire is probably a company that will mostly trail the market. I don't see any of those businesses getting out of business or getting, competed away in terms of margins, in terms of pricing power. So yeah, I think it's one of the highest moat businesses here on the list. Again, insurance business, undisruptible, energy business, undisruptible, probably getting more important in the next decades, couple of years. I think probably the biggest question after that is management. I don't know if you know Greg Abel to a bigger extent than I do. He definitely run a lot of the operations for the business, so I don't think that you will have, especially if Buffett backed him. It's not a huge like negative for me, but not having Buffett, not having Charlie Munger, it's kind of like what is the direction the company is going. So for me, it's somewhat of a questionnaire and like two of the big three questions, not so much about the mode, but about management and the reinvestment. So yeah, I see it somewhere in the middle. Is there anything that I miss and you feel like I'm wrong on?
Yeah, so I would say for the mode, I also think the like insurance float is sometimes underappreciated, right? Like using other people's money to invest. I do agree on things like the railways, like they do own assets that just can't be replicated. And if you were to build it now, A, it would probably be impossible, and B, it would be a lot more expensive. But I do have questions about the leadership and the reinvestment. And not that Greg Abel is incompetent, it's that the bar is so high. The bar is like you have this secret sauce of Warren Buffett and Charlie Munger, and you don't have that anymore. And I know they have had people kind of doing investing in the past, and it didn't seem like they were able to not necessarily pass that knowledge, but get people to kind of replicate the results they were doing. And I think the fact that they haven't been able to allocate that capital over the last few years shows the challenge it is because Buffett has openly said, like, I've been waiting for opportunities and looking for them. And it feels like the last big one they did was the Japanese trading houses.
Mhm.
So I just feel like this is a company where you're probably not going to lose a lot of money. It's solid. They're very conservative, but I don't even know if it's going to really beat the index. And I do think there is reinvestment in leadership challenges that didn't exist in the past. So myself personally, I would probably put it in the A tier, maybe the high B tier, but I also don't want all the Buffett fans to yell at me in the comments. So where do you put that, Daniel?
I agree. I think I would still give it an A, and I'm not sure if I would still say that I have so many doubts about the management team. I think a lot of the doubts in terms of performance and capital allocation generally just come from the huge cash pile. So for me, it's not so much about can Greg Abel do what Buffett did. I don't think many people are expecting that. I just think if you have $300 billion to allocate, that's incredibly difficult at that scale. Also, something that I might point out, which I never really liked, is their concentration in the equity portfolio. So for me, if you're a company like Berkshire and I see that you have like 40% of your equity stakes in Apple, and Apple is a company that I would personally not invest in right now, that's another, I would say, yellow flag. And it's also something that makes the job for Abel more difficult, right? So you have 300 billion to allocate, and then you have 40% of your current equity portfolio in Apple. So those are two things that, in my opinion, are quite difficult to handle. Yeah, even if Greg Abel is the right person, I think it just makes his job significantly more difficult. So I agree. Like looking forward, I'd probably say low A tier, high B tier.
Yeah, so let's put it there in the A tier here. And I think Apple's actually a good point. Let's say the world is in a different spot in 5 years and AI and Apple's competitive mode is different. Is he gonna know when to sell that position, when to double down the same way Buffett did? And it's a challenge. Again, he has big shoes to fill. I think he'll do an adequate job. I'm just not sure it's the home run it's been for the last like 5 decades.
Well, that's difficult. On the other hand, though, maybe we should also talk about a chance, which is that Buffett and Munger were still both not investing in tech. So technically, you could now have someone at the helm of the company that is using the 300 billion to also allocate it to tech, which, we all love Buffett, but for the last 20 years, tech has been an investment that would have been pretty profitable for them. And, a change in the management team could also mean that you have another chance to, in the next 20 years, invest more money there.
For sure. Apple's tech though, so he did one. He nailed one.
Well, you could say that consumer tech.
All right, so the next one here is Constellation, which both of us have done deep dives on. So how do you think about Constellation from a moat, a reinvestment, and a leadership standpoint?
And Constellation is an interesting one because when I get feedback on that one, I often feel like people say it goes on the too hard pile. And I fully understand that because with Constellation, you talk about a company that owns basically 1,000 subsidiaries in all different type of verticals, and it's impossible to fully understand the businesses that they own. So you mostly have somewhat of a sidecar investment where you know about their strategy, you know about their incentive structure, you know about the playbook, and you also know that it worked pretty well in the last 20, 30 years. And you kind of have to trust that they're still doing that. Personally, I still like VMS more than horizontal software companies right now. Because when I look at the changes that AI brings, what I want is a company that is operating in markets where, that at least are not that attractive to horizontal players immediately. And that also have a lot of like regulatory hurdles to even get in there. Best case scenario is the companies in that vertical don't even want to upgrade or don't need to upgrade. So all of that is stuff that applies to Constellation and basically the entire Constellation family. I not only looked at Constellation for the show, but also, at the spin-offs, talk about Topicus, talking about Lumine, but also some smaller ones. And it's generally a business model that I very much like. And I do feel like the decentralization, the general incentive structure is something that I personally like very much. And it's also a moat, right? It's something that you cannot replicate. I mean, if you would just say, okay, let's give me $20 billion and do exactly what Constellation did, I don't think that's possible. So yeah, it's a company that I like on the moat side. Management and culture, I think, is outstanding. As I said, you currently have, of course, the founder stepping down, and if Mark Landers is gone, that is, a huge upset in the community. I don't know how much time you had to look into Mark Miller. To me personally, I think of him as somewhat of a co-founder. Basically, he was basically the CEO of the company that was acquired first, so he knows the company so well that I just don't see it as a huge negative that Mark Landers is stepping down. We kind of have the same problem as with Berkshire, in my opinion. Whereas with Constellation, I mean, they just announced this new PEMS strategy where they basically acquire stakes in like publicly traded companies. And that comes with a different risk and reward profile. So mostly, I mean, you're a minority shareholder. So that means you don't have the same type of say in how you want to restructure a company. And at the same time, you're also not always welcomed. I mean, we just had the acquisition of Sabre, for example, where they even initially threatened to use a poison pill to dilute shareholders. So I think that makes it a lot more difficult. And in the verticals they play in, I feel like they're also such a huge player, Berkshire is in the overall market, that it will be difficult to replicate what they have done in the last 20 years.
Absolutely. So if we talk about the moat, I agree with you. I've done quite a bit of diligence on AI risks and disruption in software. And I think Constellation is very well positioned to be, let's say, net neutral in this space when a lot of people, I think, are like have a huge headwind ahead of them. And I think the reason is they do have the diversification of assets. They have over, 800 or 1,000 of these VMS softwares. And I think they were picked purposely. Like mission critical software for industries that are kind of too small for other people to target. So they kind of have these two sides. They have these really small companies like cemetery management, which literally shows like the plotting and where the graves are and things like that. And those people generally don't have enough time to change software and they're busy with things in the physical world. And then you have companies like court systems for municipalities where your customers are government and government customers notoriously move slow, have high switching costs, they have chain of custody, and they don't have a lot of reason to move. Now, you can say it's hard to know what all 1,000 of those companies are. And I think that's accurate. I think they are going to be certain companies there that we haven't identified that will be at a higher risk for AI. But I think if you look at it as an entire group, I think they're pretty well protected in this space. From the reinvestment side of things, I think they've done a phenomenal job in the past. I don't put them in the same space as Berkshire, where I don't think they're quite that big yet. I think it actually may be similar to Berkshire decades ago, where people thought they were too big, but there was more runway than we thought. And I think something like the Sabre deal, for example, is just another kind of option, but it is a change in the business model. And the good news is Mark Leonard is still involved there. On the leadership side of things, I think this is one thing that makes them actually different than a Berkshire. And that is that Mark Leonard early on realized that bureaucracy comes in companies as they get larger and that there is things like keyman risk. So he's been building the playbooks, the decentralization from the start. So although he is probably a capital allocation genius as well, and I would definitely like him to be involved in these new structures. I think for the old playbook, it's going to keep running, and I think they do have a good amount of runway. So I'd like to get your rating here first, and then I'll give you my thoughts.
Yeah, first let me get, some points out too. I feel like this new PEM strategy, for example, you have to look at it from the balance that CSI always has to strike, which is how much money can you deploy and then at what rates? Like what's the hurdle rate? What I really like about CSI, and it was mostly Mark Leonard kind of, wanting to hold this strategy, and it's called this magnetism effect, where they basically said we don't want to lower our hurdle rates because as soon as we do that, you will never get them up again. So let's say your hurdle rate is about 20%, right? Then if you're a manager at CSI, you always have to hit that 20% hurdle rate. So that, for example, means you need to negotiate harder. As soon as I tell you we are fine with 15% and you get your bonus if you reach 15%, you will never get back to 20% because he doesn't negotiate as hard anymore because he knows I'd rather make that deal instead of not making it at all because it means either I get a bonus or I don't get a bonus. So with the hurdle rate, you know that they will keep it as high as possible. And at the same time, if you want to keep the hurdle rate as high as possible, that might mean that you cannot deploy as much capital as before. Now, going into the public markets, I think there are two good arguments for doing that right now. First of all, the public markets are faster in terms of adjusting their multiples in the private markets. It's also something they told about. So whenever
Yep.
we said that multiples are going down in the space because of AI, that's not true in the public market. That's true in the public market. It's not true in the private market. So buying in the public market right now is probably cheaper than it has been before. And it also means that you can deploy much more capital than in these little, I mean, you talk about $3 to $5 million acquisitions in the private market. They're usually doing about 100, 120 times a year. And then in the public market, you can deploy 10 times that amount in just one acquisition. So there's certainly a strategy change that makes them able to invest a lot more money, and especially at current multiples, also hit their hurdle rates. So that's something that I certainly like to see. Getting to the rating here, I don't know if it's too low for you, but if we have Berkshire Hathaway in A, I would actually put Constellation in B, although I personally think that it's probably a better investment right now.
Yeah, so I would have Constellation above Berkshire Hathaway right now. So I
Mhm.
would have it at the bottom of S tier or the top of A tier, somewhere in that range. And I think there's just less key man risk than Berkshire. And I think they have more runway than Berkshire. From a moat standpoint, I think Berkshire might actually be stronger because they have more things in the physical world.
Yeah.
But kind of with the setup, I would have Constellation much higher than you on this one. So we can disagree. So where should we end them up? Do you want them at the high end of B or the low end of A?
I think low end of A is perfectly fine. I think I
Okay.
mostly look at it from the mode perspective. And I don't want to sit here and like look back at this 5 years from now and saying that, the energy business of Berkshire, the insurance business of Berkshire doesn't have a better mode than, software in the age of AI. I mean, one thing or one risk that we should maybe talk about is, for example, agents. Currently, it looks like we will probably have horizontal agents, not vertical agents that could, for example, be deployed by Constellation. If that's the case, I don't see it as a huge thing for Constellation, mostly because, again, in these small verticals, there's a high likelihood you don't even need these agents. I mean, you just talked about cemetery management software. How many agents do you need to actually work in that software? Not a lot of them, but especially for the larger segments they operate in, talk about healthcare and stuff like that. I could see that happening, and then you have at least some risk of lower margins, lower pricing power, that sort of stuff. So from a mode perspective, I put it below Berkshire. Where would I currently invest? Constellation Software, so I think it's totally fair to have it in the A tier.
Yeah, I think that's fair. Have you used Claude Cowork at all?
I did. I just actually vibe coded a software recently to compare it to some of the other tools out there, Base 44, and I used Cloud Code for that. It's an
Okay.
amazing feature.
Yeah, so if you use Claude Cowork, you can actually see what it can do on top of horizontal and vertical software. Like it can do actions for you inside. So I do think there is a risk there. So I would agree that Berkshire's moat is stronger. And if I wanted to just put a large sum of money and not think about it for 20 years, I would feel more comfortable in Berkshire. But I think the CSI setup right now is a lot better. All right, let's move on to a company that maybe is not at the same quality, but I'd love to get your thoughts here. I know you've done a deep dive as well. PayPal.
Yeah, PayPal is one of the companies that are probably our biggest mistakes. I covered it, gosh, a couple of months ago, probably, and it was a company that was trading cheaply. Now, being cheap is not an investment thesis in itself, but it also had a lot of catalysts going for it. So, I mean, first of all, if you're based in the US, you probably don't know how many people actually still use PayPal. I use it on a daily basis. Everybody around me uses it on a daily basis. We talk about 400 million active accounts. We talk about 30 million merchants. So, if we just talk about give me capital, give me $10 billion and replicate that, it's actually quite difficult to replicate it. You're also talking about Venmo in the US, for example, and that's probably an app where you have more social network effects, which PayPal in itself, especially in Europe, doesn't have to the same extent. The big problem is where do they make money? And their money is not laying with PayPal sending peer to peer. It's not laying in Venmo. It's not laying in Braintree, which is basically their B2B option. So that's not where they make their margin. That's not where they make their money. They make their money in the checkout on websites, right? And that's a
Yeah.
market that's highly competitive. So you have Apple Pay, which in the early beginnings, you could still say, well, it's mostly to pay in store. It's not anymore. Apple Pay is online. You have Google Pay. You have Shop Pay, which is created by Shopify. So
Yep.
it's a highly competitive field. And, PayPal historically always had high take rates. And that's something that you can't continue to, justify in a field that is highly competitive. So I think if we talk about a moat, by now it's almost non-existent. Even on the merchant side, you have Stripe and you have Adyen, which is a company you just covered recently. So I think you don't have a strong moat. And if all the catalysts that seem to have been there, so for example, we talk about an ad business and all of that stuff, is not working out, and you're just cheap, it's just not enough. And then maybe because I have to talk about it, probably the biggest disadvantage of PayPal and the reason why you should invest is the management team. I think the management team has just not done a good job. I actually liked the former CEO, Alex Chris. I think he was on the right path. I think he wanted the right things for the company. And the other management team is just Incentive structure is not great. They're getting paid a lot of money, even if they don't do a good job. Communication isn't great. A lot of the times you got metrics which didn't really match the overall goal. It was all a bit weird, all a bit odd. So I think the management has been the biggest red flag. And then if you combine a bad management team and not a strong mode, it's incredibly difficult to succeed as a business.
Yeah, I would agree on all that. I think leadership has been horrible. I think they've gone through multiple CEOs over the last few years. There's no inside ownership. There's no real like cultural continuity and vision here. And if I ever hear people saying, "Why are you buying PayPal?" the only reason is it's cheap. And for me, that's not enough. So where would you put this one?
Looking at the companies that we also still cover, let's quickly think about that for a minute. I would be inclined to probably put it into the, I would say, low C tier, because I have some companies here on the list. If we just talk about moats, PayPal wouldn't be below them currently. So I would put in low C tier, but I would also go with D tier if you want to do that.
All right, let's put it in the D tier then. Again,
That's
that
fair.
doesn't mean that you can't do well, right? You can do well on it and any stock if there's a turnaround. This is definitely just not checking any boxes for me as something that I
Yeah.
would want to own.
One thing maybe on the positive side, if we say it's a cheap company. So as a financial analyst, they currently, I think, have a buyback yield of about 13%. So they actually spend a lot of money on buying back their own stock. So that's
Yep,
one thing. I would say, though, that's part of the thesis of just being cheap. So if I don't see the business going in the right direction too, which it looked like a year ago, it doesn't look like that anymore. I just think it's not a good investment to make.
absolutely. All right, now let's talk about Copart. Maybe you can talk through what Copart is because most people don't know, and then through the moat and the reinvestment in leadership.
Yeah, Copart is a great business. They actually run junkyards all over the US and also even more by now internationally. It's a duopoly market generally. So you could imagine it that way, that if a car gets totaled, usually, it's being placed in one of the junkyards of Copart. Their customers are generally insurance companies. And the interesting market dynamic here is that there are only two companies that serve the insurance companies in this way, but they do so in a very different way. Copart is a company that historically has always bought the land that it owns, that it operates on, so the junkyards. IAA has been a company that always rented those lands. And that's a huge difference because, as you can imagine, nobody wants a junkyard in, next to their house, for example. So it's not easy because of zoning rules and all of that stuff to make new yards work. And when that's the case, you would rather own yards than just rent them out, because in the long term, it could always happen that you're not allowed to rent that land anymore. It could also happen that you need more land and you cannot rent new land. So if you own those, that's a huge advantage. By the way, just a side note, they have all those junkyards still on the books with the prices that they initially bought them, and that could have been 20 or 30 years ago.
Yep.
So by now, also just the real estate they own will be worth a lot more than it's with on the books. One thing that you should note about this duopoly dynamic is that insurance companies obviously have an incentive not to let this market turn into a monopoly. So even though Copart has been the better operator for a long time, let's say the last 10, 20 years, it's still always used to be a duopoly between IA and Copart, just because insurance companies don't want to give any of those companies more market power. So that's where you also see somewhat of a shift now, where Copart has, historically had a market share of about 60%. No, not 60% in terms of the overall market, but like if you compare the market share generally between IA and Copart, which is 80%, but 60% of that market has been Copart's and the rest has been IA. And that has been changing because IA got acquired by a different company and now it's operating at a much higher level. So those are the headwinds that Copart is currently facing. Their main operator, their main competitor is operating better. You also have higher uninsurance rates on cars, which is a headwind. And yeah, that's kind of why Copart stock didn't perform too well. I still think if you think about the mode, once again, the test, like, give me $20 billion. Could I replicate what Copart has? Absolutely not. Could you do it in 10 years' time? Probably even worse to think about that, because I mean, by then, all the junkyards that Copart has built, you cannot get to them. So I think it's one of the highest mode companies. It will always be a duopoly, so you will never get monopoly like margins, no matter how good they operate. Management and culture, fantastic. I mean, you can also read a book about it. But the founder, Willis Johnson, he seems like a fantastic guy. He kind of has like this philosophy of watch your pennies. So he's very like meticulous in how he spends money. You also saw that in the second and now the third CEO. So yeah, high management alignment. They're pretty good with buybacks. Pretty good actually means that they don't buy back a lot of stock except for when it's trading cheaply. And just recently, they started buying back stock again. So maybe that's also a good sign for the stock right now.
Yeah, absolutely. And you were mentioning, buying land 20, 30 years ago. There's also like no debt there. Everything's
Yeah,
fully paid off. It is really hard to construct a scenario where this business doesn't exist in 10 years. I think what people think is a headwind here is the risk of autonomous vehicles, right? So if we
exactly.
live in a world where there's all autonomous vehicles in whatever time frame you want to say, 10, 20 years, and there's less accidents, there's going to be less of a need for Copart. On the flip side, right now, cars are getting totaled a lot easier because cars are not as, I don't know if the right word is, durable as they were in the
Yeah,
past. So a
yeah.
small kind of fender bender now becomes, it ends up going to the junkyard now. So I think on the short term, the business will continue to grow. I think they are also growing the size of the junkyards. I believe they're able to expand it. So that's another
Well,
opportunity. And
another
you might,
huge
sorry, go ahead.
Yeah. Another huge tailwind mostly is that the US market is mostly mature, but they go into international markets. And so they have two types of business models. And one is that, especially internationally, the service model that is the main model in the US is not yet as well known. So mostly they just buy cars themselves, have it in their inventory, and then they sell it on their marketplace for more money. So that's kind of how they show the businesses internationally that what they do, basically their marketplace works. And after doing that, they mostly switch to the service model where the insurance companies become the customers. That's a high margin business, certainly higher margin than having the or buying the cars yourself. And you can already see that if you look at the international revenue, it turns into a higher margin business internationally because of the switch from buying cars yourself to the service model. So I would say that if you want this company to see, or if you want to see growth with this company, it's significantly more likely to come from the international markets than the US markets. And that's something where they can also reinvest a lot of money. So talking about the run rate long term, I see them putting money down there, also in different verticals. So currently you have them mostly just in the car business. They go into the motorsports business. They go into other verticals. That will certainly be smaller than the main business, but I think over time they can allocate a lot of capital there. Also, that would kind of reduce the risk of AVs and EVs because in the motorsport business, in other parts of the business, you don't have the same risks. But yeah, that will probably always be a smaller general market than the core market.
Yeah, absolutely. And then you also have kind of things like natural disasters. When natural disasters
Yeah.
happen, there's still an opportunity there where they need all those cars moved right away urgently. And then there's like zoning and regulation. Like they're not making more of this land. This is the type of
Yeah.
stuff that people in the community, if it's near them, they're going to protest. They don't want this in their area. Where do you land on Copart?
I think looking at the companies that we have an A tier, I would give it a high B tier. I do think that talking about the junkyards and all of that stuff, it's just impossible to replicate. The problem is if you have a perfect business, but there is no need for the business model anymore, that's a problem. And if you think about AVs, I think the risk isn't high, but if I compare it to Berkshire Hathaway, to Constellation Software, I think it's more likely to be disrupted in 20 years' time than those two companies. So I think I would put it high up in the B tier. I could also live with A tier.
Yeah, I probably had it at an A tier, but I think for this, we'll go with your rating here in the B tier. And I think that might upset people that think it should be in the S tier, but I think there is an existential risk that's going to come at some point.
I
And I
think
think the debate is the time frame, right? Some people might think
absolutely.
5 years, some people might think 30 years, but it will come eventually.
It's mostly about the time frame. I feel like a lot of people are underestimating what a mode actually means. But now I like to differentiate between competitive advantages and a mode. And competitive advantages are something that a company can have over the next, let's say, 5 or 6 years. If you actually have a mode, and I should compare you to a company like Berkshire Hathaway, we need to talk about at least 20 years where that mode is actually active, right? And for
Yeah,
a company that is facing existential threats, even if it's 20 years out, I do feel like that should be acknowledged and set the rating also because investors care about terminal value, right? So if we know that in 20 years' time something will happen, or at least we can say with 80% certainty, investors will, care about that way earlier than 20 years. So I think it's something that we should consider.
absolutely. Okay, so next one here is Chapters Group, and I'll let you take the lead here because you've done a lot more diligence on this than I have.
Yeah, Chapters Group is a company that, if you want to make it easy, you can say it's kind of like a very small constellation software. It's operating in the DACH region, which is basically Germany, Austria, Switzerland, like the Central European market. It's significantly smaller. Like you were talking about a market cap here of about 700 to 800 million euros, which also means that you don't yet have the scale advantages. Of course, you can say that means you have more run rate left in the next, decades, and that's the thesis that you have for this company. But it also means that it's way easier to get disrupted, right? You have more PE companies coming into Europe, which is something that you have already seen in North America, and you know that companies like Constellation can handle that. You have not yet seen a test for that for smaller companies in Europe. Topicus can handle that. What about companies like Chapters Group? You don't know that yet. They also are focused on mostly like government agencies and public sector institutions. And then you have a fintech arm as well. So it's not like they're totally, totally diversified into the or in terms of verticals they operate in. And there are certain headwinds and tailwinds that come with that. If anyone wants a deep dive again on all of these companies, we have a deep dive in our podcast and also on Chapters Group. But for example, their fintech business is mostly focused on people who come to Germany as migrants, especially working migrants and people who want to study there. So, anything that would change the amount of people or the number of people who would come into Germany would immediately tackle that business or would be a headwind. On the other hand, all of those businesses are highly regulated. So I actually think that it's kind of hard to disrupt them. It's very difficult for other players to get into that. So I think it's from a moat perspective, in terms of the companies they currently own, quite well positioned. But you still are so small that I would say you just cannot talk about it with the same type of moat as Constellation has. And if we put Copart at B, I can already tell you that Chapters Group, from a moat perspective, could not end up there as well. So I'm already thinking about if we put Copart a bit too low there. But yeah, I mean, maybe on the management team because it's also interesting. You have a CEO who's quite young and who would probably consider himself a value investor. That's something that I personally like to see. And we have like a lot of famous investors in this stock. I gotta say that does not necessarily need to be a good thing because like these wealthy, famous investors in stocks, they usually own a wide diversified portfolio of stocks. But you have Mitch Wales, founder of Danaher, owning 15% of the company. You have the founder of Spotify, Daniel Ek owning 11%. You have William Thorndike in there. And so you really have some people who not only give money, but also a lot of know-how to the company, which I always think is pretty helpful. And they also give you the playbook. And I think we have seen with Constellation that it's incredibly important to have the right playbook. I think that's the case with Chapters. So I like the company, but it's a highly speculative bet at this point.
So where would this land? I don't have much to say outside of the
Yeah,
fact that a lot smaller. So just it being smaller kind of took it out of my realm of things to invest in because I just don't trust that they have the playbook yet and that one or
absolutely.
two mistakes can make a lot bigger impact. And then also when you think of like a constellation, when they're thinking about AI, they're developing a playbook and learning best practices within the
Yeah,
org that they can use across the board. And I think the smaller serial acquirers have a disadvantage there. So where do you
absolutely.
land on this? And you're allowed to say the low end or the high end of something if you do want to compare, like if
I'm kind
Copart's
of
at the highest possible end of B, I'll leave you
which
with
it
that.
is. Yeah, I feel like I'm a bit harsh maybe today, but I would say Chapters, I like the opportunity. I would still put it into the D tier. It's just way too small to actually say it has a moat anywhere close to the other companies here. And again, it's less about the quality of the business generally and more about the size of it compared to the other companies here on the list.
Okay. And how do you think about like a valuation of a chapters and also Copart we didn't mention. So I'll just jump in on the Copart valuation,
Yeah,
which to me seems like a pretty wonderful business at a fair price, but I don't think
yeah.
it's cheap. People think it's cheap because it's down quite a bit, but when I kind of look at the analysis, I don't think it's cheap yet. And chapters, I've done no diligence, so I'd love to get your thoughts.
I totally agree on Copart. I think in part why it is not yet A tier, but kind of like B tier is because people like to look at the business, see how high quality it is, and then they see where the stock, is coming from. So they immediately think like this has to be a great opportunity. If you do a DCF or like any other valuation method, I think as you said, it's a fair price. You're not yet getting a bargain. And that's the reason why the management team has waited so long with actually buying back stock. There were people like when the stock was up 30% from today's prices who still wanted buybacks, didn't get them. I think now it's a fair price. Chapters Group, totally honest, impossible to value at this point. Absolutely impossible. You have so much volatility in terms of how much or how many businesses they will actually acquire in a certain year, the size of those businesses. You could try a sum of the parts valuation. If you do that, I think it's fair to end up in the low 20s. If you're conservative, you can definitely have models. I've seen them that gives them a value in the mid 40s. I personally think if you can buy them in the high 20s for a speculative bet, small position, it might be fairly valued. But
Fair enough.
that's how I
It's
would go
it's
about it.
a lot lower than I thought you were gonna have it. And in general, I'm surprised we haven't seen an S tier yet.
I'm harsh. I'm harsh.
I think it's good. All right, next one is Duolingo, one of the more polarizing companies. Love to get your thoughts here, and then I'll jump in.
Yeah, another one. I don't want to spoil, but that probably doesn't reach the S tier. um, well, it's a company that I wanted to look at, and when I went into the research, I didn't think that I would like it at all. I gotta say, I think it's a better company than I initially thought it would be. Talking about the mode, like first things first, I don't think there's a huge mode. You have brand recognition. Like whenever I talk to anyone who wants to learn a new language, it doesn't matter whether they're from Germany, North America, South America, Asia, a lot of those people use Duolingo, probably the majority of them. What I don't like about the brand generally, immediately starting with that, is that if you listen to the last earnings calls, they actually mentioned how changing their marketing strategy from these unhinged memes that they mostly post to more brand recognition and maybe their philosophy, it immediately realized in, it immediately led to significantly fewer downloads and also less retention with people who use the app. I think that's never a good sign. If you have a mode and people leave you because you don't post unhinged memes on TikTok or Instagram anymore, hard to argue that you have a strong mode. What I like about them is that they are highly data focused. So if you would ask me, can you just rebuild that app with AI immediately? I would say no, you can. You have so much data from like 50 million daily active users that on like what works and what doesn't. For example, they have about 750 A/B tests per quarter. You cannot just replicate that. I would argue though, it's not that important to replicate it 100%. It's probably enough if you have an app that works 80% as well, which is significantly cheaper. So the question is, do you even need to replicate it to the same extent and quality that Duolingo is? Probably not. Management team, I gotta say, this is a weird one. The first call that I watched from the CEO, who's also the founder, Louis von Ahn, and he said on the earnings call, and I was basically sitting there. The stock was down 30%, and he was pointing at the camera, shooting up cash emojis on screen, talk about how well the quarter usually has been. And I was like sitting there and like, this is incredibly weird for a CTO, for a CEO to do. I gotta say though, looking into him more, like he's a professor, a math professor. He has already founded Recapture, which was also later sold to Google. So you guys have something in common. I think he's a pretty good CEO and he loves the company. So I would say management alignment is certainly there. I just don't think it has a moat. And if you talk about reinvestment opportunities, they open up all these new verticals. So you talk about chess, you talk about math, music. I think that what Duolingo does, so gamifying learning, works incredibly well with languages. I don't think it works as well with, with things like chess, things like music. So I'm not sure that will be a huge part of the business in 5 years' time. And I'm also not buying the thesis that this company will be the number one learning app in 10 years' time.
It's not $1 trillion opportunity. Okay. So when I think about Duolingo, there's kind of two things I think about. And the first is, what are they trying to accomplish? And I'm unsure if they are genuinely in the current state right now, optimize for outcomes. I don't know if their product is genuinely helping people at the rate that we would like in terms of actually learning the language and being able to speak it. I think that's very different than changing people's behavior so that they can use an app every day and get the illusion and the dopamine associated with learning and improving yourself. So I kind of am stuck on that. Like, which one are they actually doing? Are they selling this like nice feeling that I'm learning, or are they actually optimized for getting to the outcome as quickly as possible?
I would argue it's not even that important, or at least it doesn't have to be. I would say if you want a great company that's $1 trillion company, it's important. And, Duolingo will not be that way. But think about how gyms work. Like people love to pay for the gym and never go there. I
Yeah.
feel like Duolingo could be your feel good investment in terms of like, I want to be that type of person that learns a language. So I pay for it, even though I never actually end up doing that. It will lead to higher churn rates, which is a problem. And also look at, I mean, I think currently they have about a 9% of the active users also being paying subscribers, which is not high. And it's not a lot, especially if you count with all the churn rates. Another problem there is also that if you really think about who needs to learn languages like English, it's mostly people who do not live in either Europe or North America. So it's mostly people, for example, living in South America. And Luis von Ahn himself said that basically, if you have a pay tier and free tier, and people can use the app without paying, especially people in South America, they will do that. So you have almost no pricing power there because even if you offer the product at about $1, they would still use the free tier. And even that $1 would be so low on RPU, so the average revenue per user that you earn, that I kind of lack the creativity of how you turn the users who most likely need your product the most into actually high paying subscribers. And people in the US, people in Europe, they will probably churn at much faster rates than, for example, South American users.
It just doesn't feel like, if there's a recession, like, and I have to cancel some of my subscriptions, like Spotify, Netflix, Duolingo, like it seems like Duolingo would go first. Again, I'm not the user, so I could be wrong here. But I do like the founder. I like him quite a bit. I think he's very data driven. They're running thousands of A/B tests. I think it's incredibly high quality from a technical standpoint and what he's trying to achieve. I think he does fall for some traps where if growth isn't where he wants it to be, he'll make some changes in the app so they can hit the quarterly number. Not things I always love, but genuinely, I think he is solid. So before we talk about the valuation, where does this land for you?
Well, I think it has to be a low C tier, high D tier. I don't think it's a company with a huge moat. Just one last point on, what you mentioned with the CEO. I think he once mentioned that he tried to reach the growth points that he gave out or the guidance by doing that, like increasing the amount of ads that he showed. And he said that, that's something he wouldn't do anymore. Also, I think the current strategy of basically getting more daily active users, but basically at the limitation of not converting more people to the paid tier kind of also shows that he wants to build this company for the long term. So I do think he's a great CEO on that extent and that he's, thinking long term, not short term. But if you have to balance between converting more people to the paid tier and getting more people as daily active users, that's already a balance that's not perfect. And you would want to do both things, like get more daily active users and get more paid subscribers. There's always a balance that you have to strike. That's not optimal. By the way, with that balance, what I mean is, for example, you log into Duolingo and then you would get shown a banner, which is basically saying update to the premium tier, right? And he knows if he does that at a certain time in your learning process, some people will delete the app because they feel like that's annoying. Some people will upgrade. So that's what I mean with the balance between, getting daily active users and then getting more conversion.
Yeah. So I'll put this in the C tier. I think if there was a different founder here, it's like a very easy D tier for me. But I think he has shown his technical ability, his understanding of AI, and the fact that they've even survived this long and flourished and they've been told they're going to be killed every year. So I'll put that in the C tier. We can have it here. So again, it might be D, but I think C is a fair spot. And you mentioned low end of C tier. But when we talk about the valuation, it's been beat up quite a bit. I think this stock is down
Yeah.
80%. So if you wanted to make a bet on this founder and the company is like free cash flow positive, I don't think it's an unreasonable bet to make if you have confidence that they will solve problems in this space and they will be highly specialized while the other AI players will be more generalists.
I totally agree. After my episode, I actually thought that, this could be a speculative position, very small. I think in my personal portfolio back then, initiated very small speculative position. So just from a valuation perspective, I don't think this is like an expensive stock at all. I think it's actually quite cheap. Yeah, I would agree with that.
Yeah. And that's one of those things, just because it's beaten down and it doesn't mean that it's a garbage company either. It's just it's a good company. The moat isn't very strong, but the founder's strong. So do your diligence and figure that out. All right, next is Lululemon.
Well, with Lululemon, you actually got to give me some insight because it's a company that we do own in our portfolio, but it's mostly because of my co-host Sean. He's a huge fan of Lululemon. It's not a big thing in Germany and in most of Europe outside of the UK. So I don't have a lot of insights in terms of how many people actually still view Lululemon as like, the company or the clothes to have on. I feel like that's a bit difficult. I generally don't like investing in the retail space, especially fashion retail, because it's, such a fast changing space to be in. And I don't see those companies having a moat generally. Like even companies like Nike, what we've seen in the last couple of years happening to that brand just shows you that some of the best brands with the longest history in the industry can still go down quite quickly. If you just look at the numbers, that's something you can do for these companies, like in terms of figuring out what is the mode. Lululemon's margins are exceptional. I think they have about 58% gross margins. Other companies that sell, I would say to the same consumer are about 40% maybe. So, high returns on invested capital, a good working or well working DTC model. which is something that, for example, Nike struggled with. Lululemon is doing a phenomenal job there. They're kind of the company that created this athleisure category. So it seems to be a high quality company. But if I look at the competition, Alo and some of those brands, I just don't see a differentiating factor to the extent that other companies here on the list that I would, classify as A or B have.
Yeah, I feel similar. I think apparel is very tough market to be in. And I think what has happened is some of the cooler, younger, hipper people have moved on to things like Aloe. I think Lululemon still has a lot of brand recognition in North America. They are expanding in places like China. And I think their referral system has always been that this makes you look good. And when someone looks good and their friend asks them, "Where did you get these pants?" That's the whole system. And that's how it's going to grow internationally. And I think it's always been a really strong play for women. But I think leadership just doesn't really understand what their brand is. And they've moved so much into men's clothing, and men don't feel the same way. And then just some of their picks for sponsors and endorsements have been very questionable. I don't know if a 25-year-old female who's in fitness wants to see a 75-year-old woman in a commercial for Lululemon. So I feel like they've kind of lost their essence by trying to go too broad when they could just be more narrow and expand in more regions. And as I said, apparel's really tough. So I would put this pretty low. I'm not sure where you would put this.
Yeah, I would probably put it, I mean, if I compare it to, for example, Duolingo, I would say high C tier. You just can't put it anywhere close to Copart. But again, Copart would be very high B tier. So if you put anything else into B tier, it's not the level of Copart. But yeah, I would say probably C tier. Also talking about valuation, it's a cheap company right now. If you look at their metrics, buying back stock, having margins that are significantly higher than the rest of the industry, I think that's the thesis you're buying into with this company.
Yeah, it's cheap. When I look at apparel, the ones that I think are cheap is like Lululemon's cheap and I think Crocs are cheap. Like those two are just, these are cheap. So if you want cheap and you believe the brand is durable, it could be really good from here.
I agree.
All right. Let's go with Mercado Libre.
Mercado Libre is one of my favorite picks right now. I love that company. I think in terms of moat, or maybe we'll just talk about the flywheel, it's one of the strongest out there. Basically, you have the biggest e-commerce player in South America here. You have one of the biggest fintech players in South America. You have the biggest logistics network. You have just a huge flywheel effect between all of these different things. For example, if you think about Amazon and their profit maker in AWS, it's not necessarily a business that is immediately part of the Amazon flywheel in itself. It doesn't make intuitive sense how that is strengthening the other parts of the business. With MELI, that's totally different, and it's mostly about where they came from. So this is a company that's not highly innovative. It's more about copying others. So when they started out, they were basically copying eBay, and then they were copying PayPal with their fintech side. And what they basically did is that they said, okay, well, we want to build an e-commerce place. But in South America, the problem is that most people were still paying with cash. They were not buying things online. So what they needed was a payment space or like a payment operation to basically benefit the marketplace. And that's how they built the entire ecosystem. It's similar with logistics. When in the beginning, they were like, okay, well, now people trust buying online. They can use our fintech operation to buy online on our marketplace. But how do we actually get the package to them? And you didn't have the same infrastructure as in the US or in Europe. So they also built their own logistics network. And by now, all of those segments are among the biggest in South America. So huge market. I mean, market penetration in Brazil or in South America in general of e-commerce is about 14%. US is about 24%. China is over 30%. What you often see with these e-commerce or like emerging markets and e-commerce over there is that they skip some steps. So that's why usually penetration is higher than, for example, in Europe and the US 10 years out. That's something that I would also expect for Brazil and South America in general. So huge tailwinds with just, e-commerce penetration going up, more people joining online banks, joining Mercado Pago, which is their fintech operation. I think it's just a fantastic business. We can also get into the management. I mean, it was founder-led for 26 years. The CEO now changed, but I think the culture is still pretty much the same. They understand South America to an extent that no other competitor does. So I think it's a fantastic company.
What are the risks here? Like, how do you think about, are there like credit risks with the portfolio? Is there geopolitical risks? Like when I think South America, it's just, obviously everyone says Mercado Libre is fantastic, but I just don't have any insight there. So those are the things that come to mind of like
Yeah.
why I would pause, but everything else looks fantastic.
I think if you just think about the general risk of investing in South America, I don't see that as the biggest risk that you have investing in Mercado Libre, because I was compared in terms of which company or competitor is South America first. And I only see Mercado Libre. So the other big competitor that you have is Shopee, which is owned by Sea Limited, which is a Southeast Asian player. And then you also have Amazon. And then you have the Chinese players like Temu and TikTok Shop. So for none of the companies except for Mercado Libre, it would make sense, for example, if you have a recession in Brazil, to still invest heavily in Brazil, because you're basically burning money in a market that is in a recession and you don't know when it's coming back. Mercado Libre has no other choice but invest there because it's their main market. So generally, if you think about recessions, if you think about forex volatility, you should basically put that into your valuation model, especially the forex part of it. But I'm not too scared about a smaller recession or anything like that, because if I just think 10 years ahead, which company will likely come out of that stronger, I think it's Mercado Libre. The big risks that I see is certainly the credit risk, right? If you have a blow up in the credit that MELI is underwriting, that's a huge hit to the company. And if you compare to players like Nubank, they're certainly taking a lot more risk. They're lending to people that legacy banks have certainly not lent money to. Even Nubank is not lending to those people. Why
Mm,
can they do that successfully currently? Mostly because of all the data they have. Like the
interesting.
flywheel in itself with the marketplace is incredible. They lend to both sides, so consumer and merchants, and they have all the payment data. They know what you buy, when you buy it, when you buy in sale, when you need to buy and sell because you likely don't have a lot of money. On the merchant side, they, for example, if they lend money to a merchant, they factor in into the payment ecosystem. So basically, they say, okay, well, we give you $20,000. So over the next 5 months, we get a certain share of your revenue until we get our money back. That's what they do on the merchant side, which is, a great thing for them. So they lend on both sides. They have all the payment data. That's why they have a lot more insight into who they can actually lend money to, and also at what interest rate. So that's why it's a profitable business for them. But yet again, we've not yet seen a recession where you actually have a lot of loans going down, fast, because they're loaning only on an average time frame of about 3 to 4 months. So they're very short duration, which is a
Interesting.
good thing, which is something that you want. But
Yeah.
still, if you have like a recession coming quickly, you still don't know what the impact will actually be. I think you have to trust the management team in terms of acting as soon as they see signs and making it more difficult to still write new loans. I think they will do that, but it's certainly a risk factor. If you think about why the market is selling it off, I think that's like bundled into a mix of factors. So you also see the margin going down recently because of lowering the free shipping threshold, which is something that they do to still be attractive to people who would otherwise shop on Shopee and stuff like that. And also, you have a lot of customer acquisition costs with the fintech side. So it's a mix of margins going down and the credit risk. And I think that's why the stock is mostly selling off.
Okay. It seems like the stuff that would impact them is less in their control, like a recession or
Yeah.
something happens to the currency of one of the countries in South America. But that should also affect every other company. I guess maybe not the credit risk the same way, but like something like currency might. So where does this land for you? Is this like a S tier or is it close? Like, how do you think about Melly?
If this would be, and I think that's easy to say, if this would be a American company, it would certainly be S tier.
Okay.
Because it's in South America, I would still put it into the A tier because of what you just said. Basically, a lot of the risks that are not in their control, and that's kind of, you could make an argument for, well, then if it's not in their control, they can do anything about it. Could be S tier, but I would also say if you're an investor and you have a company that's not able to, control some of the risks that they might be facing, that's also not a situation you want to be in, right? And to some extent, just to give some more background, because of this uncertainty in South America, it's really in their DNA. Like when they built, for example, the logistics network, but now they own a lot of it. But in the beginning, they also used a lot of third-party carriers, for example, and they rented them out basically because they knew that a market in South America can get lost quickly. So, for example, Venezuela used to be one of their biggest markets until suddenly that market turned socialist and basically was gone from one to the other day, right? So that's when if you have a lot of like billions invested into infrastructure there, that's simply gone. So they only over time invested in markets where they knew they are relatively stable. And then they put money down in those markets. And if you look, for example, I think Brazil is about 50% revenue for them, but Argentina is actually more profitable for them, not only in terms of margin, but like actual absolute dollars. So if you could also see or you could look at the margin in two ways. You could either say Brazil is just a more competitive market, so it will be lower margin all the time. You could also say that if you think they will be the winner and that market turns out to be as profitable as Argentina, there's a lot more way to make a lot more money in that market.
Yeah, absolutely. Yeah, I think that's interesting. And I think it's similar to some of the Chinese companies too, in how they think and how you have to assess the moat. You could say, okay, it's not in Alibaba or PDD's fault if there's Chinese regulations, but that is part of your investment thesis, and you need to have that in mind. Okay, so we just talked about MELI. How about
Mhm.
Amazon?
Yep.
How do you think about Amazon?
Well, I think Amazon is probably the less risky part, and to some extent, it's kind of similar to the thesis with MELI. What I would like to focus on here more a bit is a bit, the option that they have in robotics, for example. I mean, if you just look at the money that they could save in the next, let's say, 5 to 6 years by deploying more robots into the warehouses, I think that's a huge money saver. I could easily see them saving like $30 billion. Just that's something where they are certainly more ahead of a company like MELI. And generally, of course, they have a lot more, chips and all of this AI play and also AWS. And I think one of the most astonishing things, if you look at AWS and the market share and the stability in market share over the years, I think that initially people said that this infrastructure as a service market, where Amazon is pretty huge, has less moat than some, let's say, for example, the platform part of the cloud. I don't see that at all. I think as soon or what you see in the last couple of years is that as soon as a company is choosing AWS, they basically stick with it. And the more they build on AWS, the more likely they once again are to stick with it. So again, we have similar network effects to MELI, actually stronger, where more buyers, means more sellers because you have more product on there. You have the ads business, which is, for example, something that MELI is also building currently. It's a huge possible tailwind. Amazon is basically the mature version of that in a much more stable market with a lot of upside in the AI space. So I think the mode is unquestionable. Probably the first company that I can already tell you I would put into the S tier. If you talk about management, probably Andy Jassy is not as good as Jeff Bezos, but that's often the case with the follower. But you could also say with Apple, for example, it worked pretty well that way. If you have someone who's more focused on the operating side, and I think Andy Jassy is pretty good too. Reinvestment opportunity. Gosh, I mean, they just keep investing 200 billion this year, right? So I think there's a lot of runway for them to invest, and for me, it's an S tier stock.
Yeah, so I think the mode is like unparalleled. Logistics,
Totally.
AWS, Prime, advertising. They have a ton of optionality. They have over 1 million robots, and they have 23, I think, different vertical robots already in
Yeah,
play right now. And that's just going to keep growing. And you had mentioned like Meli's not at that level, but I think in the US, it's actually more advantageous because wages are higher. So that discrepancy becomes a huge savings there. In terms of reinvestment, they've always reinvested all their capital, but they have like a massive backlog of AWS. I think it's like $244 billion. I think leadership has it's probably gotten more bureaucratic over time. I think that's natural, but I think they still have that day one mentality. And you can see that just with like the amount of optionality that's showing up now with chips and things like that. Those were decisions made 5, 7, 10 years ago. So I think Amazon is the biggest winner of AI in the physical world.
totally
And I
agree.
think anyone who's tried to compete with them in the past, like Shopify with logistics, they've all kind of just given up. I know you can say, okay, what about DoorDash or Uber with last mile? But I genuinely just think Amazon has so much branding and mindshare with us, and the prices are good and logistics are good. I have them as an S tier as well.
All
So we
right,
have our first
works
S
totally
tier
well.
here now.
We have our first S tier. That's pretty good. By the way, talking about Melly and Amazon and their dynamic, of course, also Amazon is a competitor in most of Melly's markets. And sometimes I get asked why, I think Melly can succeed if Amazon exists. It's mostly about who you compete with. So Amazon is not really competing with Melly and with Shopee and all the other e-commerce players. They're mainly competing with Amazon itself. So it's kind of Amazon Brazil against Amazon itself because you have so many opportunity costs for
Mhm.
Amazon to allocate money that if you look at the CapEx, Melly last year spent 1.3 billion on CapEx. Amazon is spending 100 times that. So obviously, if Amazon, with all their know-how and capital, would say we want to go to Brazil, we want to dominate that market, they could do that. But they themselves said it would take them a lot of capital to actually recreate what Mercado Libre has already built. And then you would have to think about where does Amazon want to allocate that capital? AWS, AI, robotics. onto an unprofitable Brazilian e-commerce market. And that's not only me saying it's unlikely, it hasn't happened in the last 10 years. You've seen that already. That's why MELI could succeed. So that's why I'm saying if you talk about MELI as an A tier mode, and you could easily argue that if Amazon wants to invest $30 billion in Brazil, they could replace MELI very likely, but it just doesn't make any sense for them to spend $30 billion in Brazil while they could spend $30 billion on AWS, on AI, on robotics, and all of that stuff. So that's basically the argument here.
Yep, I think that's totally reasonable. And how do you think about the pricing for Amazon? I know it's gone up over the last few weeks. It still seems like it's fairly priced to me. I think it might have actually been cheap like a month ago or even 2 weeks ago.
Yeah,
How do you think about it?
we actually bought it for our portfolio, made it one of our biggest positions at I think 197 because we felt like
Awesome.
Amazon below 200 is like feels like a gift. We were right now, I mean, just a couple of weeks later, but that was totally luck. Nothing else. But I still think it's probably a good company if you buy it at these prices for the next, let's say, 10 years. But obviously, getting it below 200 felt like a gift.
Yeah. I can't imagine a world where in 10 years Amazon's not stronger. Like that's hard for me
Almost
to
impossible.
imagine. Yeah.
Yeah.
Okay. Another monster multi-trillion dollar company, Microsoft. How do you think about Microsoft?
Microsoft is interesting because when I looked at it for our podcast, I actually felt like this might be the Google of 2026. Last year, we invested in Google and it was our biggest position. It was also our biggest winner, which is kind of a good combination to have. I felt like Microsoft might be that in this year. First of all, it's a great company. Like you just obviously have a huge moat, right? You have Azure and the cloud business. You have Microsoft Office, which is still, generating, I think, about $70 billion in profits. So it's a huge business. And basically you have this reinforcing nature within the business where they mostly address enterprises. And when they do that, they sell them their Office suite, they sell them Azure, they sell them all the products that they have. I mean, the latest product has been Copilot, and that's probably the least bullish outcome for them. They also have the personal computing space and the gaming space. If you actually look at the numbers for the overall thesis for Microsoft, it doesn't play a huge role. So it's mostly focusing on what they do in AI, Azure, and the Microsoft Office products. I gotta say that when I look at management, I think Satya Nadella is a great CEO, but he definitely had his, I would say, missteps. Just to mention it, because just said, gaming doesn't play a huge role, but they actually spent $75 billion on an acquisition of Activision and
Yeah.
basically didn't do anything with it. Where I was like, if you spent $75 billion, I would assume you had a plan. Didn't work out that well. For Copilot, to me, currently, it feels somewhat like Meta back then, where they basically rebrand the entire company. I mean, still it's called Microsoft, but they have like 78 products that are called Copilot something, and Copilot isn't
Really?
working well. Yes. So it's like, what exactly is your goal there? It doesn't seem to work well. And it also doesn't make that much sense because basically Copilot is just a ChatGPT model because of their stake in OpenAI.
Yeah.
And what they try to do is basically use Copilot and integrate it into like a company's workflow so that it works better for that company because it has all the data on that company and it can work on a more individualized level. That didn't work out that well because it's kind of difficult to get all the permissions for Copilot and also not giving it access to stuff that it shouldn't access. As you can imagine, like if you're an employee of like a huge company, you don't spend 4 hours a day going through SharePoint and trying to find files that you shouldn't have access to, but you do. Copilot does that because Copilot looks for everything that it can access. That's a huge problem for companies. And also just if you want to talk about like the Office suite, which I feel like is one of the biggest bear cases, I'm not saying it won't exist in like 10 years' time. The most likely scenario is that it is. But how much time will you as a human actually spend in PowerPoint, in Word, or in Excel when most of the work is likely going to be done by an LLM? That's something that which just, begs the question of like how much pricing power is left. You certainly will have seat compression over time
Think
and you
so.
will have less pricing power because most of the work done in that layout is by an agent. So what does it do to the subscription that people are paying? And I think that's somewhat of an open question. Microsoft's answer has been to basically own the entire stack, and with Copilot, also owning the AI part of it and potentially the agent part. Through Copilot, for example, by now, you can access all sorts of LLMs, which I think is a smart move. Because you basically say, if I can win this, at least let me use Claude within the Microsoft ecosystem still, so that at least you won't cancel your subscriptions over time, right? But I still think it's difficult to figure out what the pricing power on that is. If you would ask me, like, Is it more likely this investment will work out in 5 years' time? I think it is. But I think there are a lot more questions about their mode long term than there has been with Google. And if you would compare to Amazon, I think that's also the case. So yeah, I think that's where they're currently standing.
Yeah, so I think a couple things I want to add there is Copilot share dropped quite a bit and it has not been sticky. I would say it's been
Yeah.
a failure within the enterprise so far. They also don't have their own custom silicon. They don't have their own LLM. They don't have the physical world infrastructure that Amazon has. So I just don't have them in that kind of same realm as Amazon or Google, to be honest. But they do have a ton of enterprise lock-in. But I do think that C compression factor is important from a Microsoft world because typically you deploy Office, for example, to your entire org. So it doesn't matter where the job loss comes from, it will impact Microsoft in seats. So where do you land on Microsoft?
I would still say it's at least high A tier. And I still think there's an argument to make to put it. I don't even know if there's a low S tier. I think if something is S tier, it's S tier. I think saying something is low S tier doesn't work. So I would probably put it into high A tier. And by the way, Microsoft is also working on their own models and also on silicon. So
Okay.
again, like if you would ask me like in 5 years' time, most likely a lot of that stuff will have succeeded and the company is doing perfectly fine. Also on the office world, maybe we should just get into that for 1 minute. You just have to think about like a lot of these smaller startups, they're using the Google Workspace now. We're doing that too, for example. But
Right.
if you're a big company, you only need about like, let's say 5% of spreadsheets on Excel are too complex for Google Sheets. Even just that would mean that you have to be subscribed to the Office product still and not switch to Google Sheets. So I feel like there's a huge customer lock-in still. And even, I mean, I talk to some people in the AI space and they tell me, one of the problems is also that Office has been created for humans. So, for example, if you're in Word and you try to write something or structure something, AI is not doing that good of a job, especially Copilot, because it's programmed for humans. It's not like LaTeX, for example, where it's significantly easier for AI to work in. But does all of that matter? I don't think so because you have so many things that are just, handled in Excel and Word and PowerPoint over the years that I think nobody will change. Again, the main question is seat compression and how much time will you actually spend there?
Yeah, and I think there's a lot of the stuff people want LLMs to do inside of Office was already being done with macros and automation and scripts. So if things are repeatable in Excel, like people, companies, enterprise companies were already doing that with automation. So doing it in real time with LLM wasn't quite the huge advantage at this stage in the AI game. And then the funny story is when my company got acquired by Google, so my product actually helped businesses switch from Microsoft to Google. And it was a change management solution. And started working with their legal team during the acquisition process, and they used Word. So I had to pay for Microsoft Office, even though to interact with Google. So that lock-in still existed. I probably with the finance team and the legal team and and everyone else used Google, obviously. All right, so maybe we can tackle these two together here. LVMH and Hermes.
I would say if we discuss two of them at the same time, the first question that I kind of would answer is like, which one would I much more like, or which one am I more likely to own? And that's certainly MS. I feel like the luxury space is like special in many ways. So we just talked about how fashion retail in itself is pretty difficult to invest in. I would say luxury fashion is like something completely different because you just don't have the same dynamics. You have a lot more pricing power. You have people who want to spend a lot of money, so your margins are significantly better. The thing about luxury, though, is that it's difficult to diversify it. But most of the time, when you diversify from a luxury brand that actually works quite well, you are diluting quality. I feel like LVMH is at that point. Like, the more brands you buy, the less likely they have the same quality as the ones before. So, for example, LVMH, and you actually see that the top 0.1% market is a lot more profitable, is growing a lot faster, and that's where MS is operating, not necessarily LVMH. So, just for example, I think the top 0.1% of luxury buyers, that cohort is growing like 9% a year, where the aspirational buyers are growing about 1% or low single digits. And at the same time, aspirational buyers are a lot more cyclical. So, one thing that you like to see with luxury companies is that they are less cyclical than the overall fashion industry. You don't necessarily see them with luxury companies that are not as luxurious anymore. That's not like A tier in terms of luxury. And I feel like MS is certainly there. LVMH much less so. I also don't necessarily like the diversification in certain aspects. So like alcohol, for example, is, a market that I don't think has like a huge future. It's always, even in that market, it's a bit difficult or different if you sell luxurious alcohol against just like, normal beverages. But if I would have to choose one, it's certainly MS. If you look at the company in detail and you know how they operate, what they pay attention to, the management team. I mean, for example, if you're one of the MS heirs and you want to go into the executive suite, before that, you basically have to work a decade at the company. And I'm not talking about like the executive level, but actually work in the company and normal roles. So, for example, like how do you actually create these bags and all of that stuff? So you really get a feel for how the company works at every different level, and only then you're allowed to get into the executive suite. That's something that's not the case for LVMH. Talk about key man risk. Bernard Arnault is not there anymore. How well will his heirs do? I'm not that sure. MS has already gone through that. They perform very well. They know about their strength. So, not going to Asia to produce products, which is something that LVMH also does. MS doesn't do that. They only operate in France. And then in markets like Italy for just products that you want to come out of Italy, or Switzerland if you talk about watches. So I feel like that's probably my pick if I have to compare those two.
Okay. On my end, I think they're pretty close to each other and for different reasons. So what I like about LVMH, and I guess to kind of back up and why this is nothing like Lululemon, both of these companies, their goal is for the brand to be more desirable a decade from now. And they do that by selling heritage, right? A lot of the companies that they own are like 100-year plus, you can't be copied. And then where it's made, right? If it's made in Paris or in France or in Italy, that's you can't replicate that being made in China or made in USA even. What I like about LVMH is I do like the Tiffany's acquisition. So I think some of these acquisitions have been very powerful and they've been able to extract pricing power. But I do agree that a lot of them kind of dilute the brand. I think Sephora is growing and I think Sephora is just going to continue to be a monster. But I do think Arnault is key man risk, right? I think there's like 4 or 5 kids, and it's not really clear who's taking over next. Well, Hermes, I think they've gone through like 5 or 6 generations, so they have a system here. I also think Hermes is probably more focused on craftsmanship, while LVMH is more focused on fashion, if that makes sense. And I think that's why Hermes is what the people are buying in the point one. So I'm kind of on the fence on these 2. Hermes is probably the better quality business, but I mean, I like Bernard Arnault and what he's done and the acquisition machine. So, um, I'd love to know your thoughts, just kind of where do you have these in the same tier, or are they in different tiers of businesses for you?
I certainly have them in different tiers. I also think that the goal might be the same for them to have a more aspirational brand or like a stronger brand in 10 years' time. But every single luxury company wants to do that. And not a lot of them actually do it. So just thinking about how many LVMH bags you see out there. Like I think Gucci is a brand that you kind of can compare that well. With Gucci, if I see it outside, I don't even think anymore like, oh, that person has to have money because it wears Gucci. I mostly think it's fake. And I actually think that a lot of the LVMH brands go into that direction. I know that's
Mm,
kind of harsh. Like they have a lot of strong brands too, but to me, they're certainly not in the same tier because with MS, you don't see that at all. Like the retail value alone of those bags, if you just compare that to LVMH bags or other bags of, or just not only bags, but other products of the LVMH brand, I think it's totally different. I would probably put MS into the S tier. I think the history and all of that is just you can't replicate that. Again, the Tesla give me $50 billion. I couldn't replicate MS. LVMH, I could probably replicate that more. Not so much the brand LVMH itself, but just the conglomerate of luxury companies. Yeah,
so I think there's one thing you're discounting with LVMH, and that is that they have very strategically acquired property in the best spots, in the best cities, and that is very hard to replicate. Like, they have giant stores in the best location in Paris, in New York, and they've been doing that over decades. And from a valuation standpoint, those are still on the books from the old prices. And even things like spirits, right? Like, they have spirits on the books, but as you know, 80 years later, a spirit is only worth more and more over time. So they do have a lot of these, like, little hidden assets, and although we know Hermes works and it's been working for 200, years, it is still one product. And that makes me nervous in terms of, I don't know, in 50 years, is everyone going to be changing their behavior? So I don't know. Any thoughts on that? Or do you feel like it's still just going to be business as usual 50 years down the road and everyone's going to be claiming for these Hermes bags?
I think it will. I think at the luxury space, I see less diversification as something that's good. If your product is something that it's different for Ferrari, for example. Like if you sell a product where I could actually see a case in a 50 years time, the market will be totally different. So you're not buying or driving the same type of car. Like that's totally different. Handbags, which are their main products,
Yeah.
um, I still see them being around in 50 years time. And I think it's also much easier to just think about one brand. And as you said, one product, there are more products, but let's just say you see the handbags and to kind of make sure that brand and that product is still as aspirational or desirable in 20 years time. I think that's more difficult to do for a lot of different brands, but I can see both ways. I think it's kind of like subjective what you like more. Where would you
Putting
see LVMH?
LVMH, I would probably I would have it in the A tier. Where would you have it?
I'm fine with that. I would say A tier, probably lower than some other companies there, but I think A tier is certainly fine.
Yeah. And I think from a valuation standpoint, I think LVMH right now is cheaper, but these companies never get dirt cheap because
Yeah,
everyone knows that they've been around for 100 years in the brand. So some of the stuff we've talked about, I think that's always going to be apparent in the stock price, and you're not going to get this at 15x or something like that.
that's certainly true. Although, I mean, MS just came down, especially, I mean, it already came down and now after earnings, it came down even more. There were some details in the earnings, which I think the market didn't like. I understand that, but I think it's all more short term than long term. So I don't see any problems with the brand in itself. So probably it's cheaper than it has been, at most points in the last decade. So if one wants to buy it, I think it's a good time. At the same time, I would still say that it is a company where I feel like it's probably trailing the market or performing a little better than it. So I kind of see it in the same way that I would see Berkshire from just performance perspective. So it's not a company where I would say it's a screaming buy, even though the prices have come down a little. It's still expensive, certainly.
Awesome. All right. Next is Netflix. How do you think about Netflix?
Netflix is a company that we put in our portfolio not too long ago. And we actually, at least I hoped that the Warner Brothers deal would not go through. I felt like that has been a deal where you would buy IP at a very high price. And what I like about Netflix is its ability to monetize IP that's not even as strong, or maybe that's new. And you don't need these huge, expensive IPs that have worked well historically. If that would have been the case, they would have lost the streaming wars against Disney. Disney certainly had the strongest IP out of all those players, and they still couldn't make it work. I think Netflix is just a company where if you have subscriptions and you think which one can you throw out, you just said Duolingo is one of them, which you immediately get rid of. Netflix is the one that I probably always keep. Like I have a Netflix subscription and I
Same.
barely ever use it, but it
Oh,
doesn't matter. Like I still
I
keep
use
it.
it every day.
Well, that's even better. Then you don't waste money like I do. But I think it's certainly one that you don't get rid of. And I actually tried out all the other services lately when we also researched Netflix. The incredible thing is Netflix simply works better. Like if you're on Disney Plus and type in skip 3 times, it doesn't do that. Like you're waiting for like 10 seconds. It's incredible. That would never happen with Netflix. So I think it has been the winner of the streaming wars. I think just brand recognition and all of that just gives it a huge moat. One thing that they do phenomenally well, which I also only realized lately, is that they do these local shows
I
and
was
they
going to say
have
that they're
exactly like
fantastic.
they have these local shows and they turn them into global hits. You don't see any other player doing that. If there's a global hit, it's one of those that are either a huge IP or they spend so much money on it that it was expected to be a global hit. Netflix doesn't need to do that. So if it's in the recommendation engine, if it's how well the website generally works, I feel like it's just by far the best operator. And by now, you've also built a capex mode where you have to spend so much money that
Agreed.
outside of the oligopoly that you're currently in, the barriers to entry are high. So it's one of my favorite plays to play the IP way or like the playbook without actually having to pay for Warner Brothers these insane amounts that Paramount paid or anything else. So I really like it. The business model and also I think the CEO, the management team has been great too. Although there's this change now, you have a co-CEO right now, but I still feel like the culture in the company is just fantastic.
Yeah, it's interesting. They have to spend money to maintain their content library,
Mhm.
but that content library it depreciates, but it is evergreen where you could watch it later
Yep.
on. I also think that Netflix as a studio now is probably going to be the company that will use AI the best out of the big players. You might have some kind of like startup moving into the space, but I think they'll do a better job than Disney and Paramount and those other companies. I think they even acquired like Ben Affleck's AI company. I don't know much
Yeah.
about it, but they're obviously thinking about that. And one thing that's really impressed me is I don't know if you've ever played games on Netflix. So they have this
I
new
haven't.
section called games, right? So easy games like Tetris and Boggle, and a QR code goes and you scan your phone and then you can play with all your friends for free on your phone with the TV party games. So I just really like how innovative. I think the Netflix controller is the number one app in the App Store. Like
Wow.
I think so because I saw the other day like a picture that Meta AI at second, and I saw the Netflix controller at first. So it's just really interesting how they're able to like gracefully move into other spaces, and they'll win that market that, you already have a Netflix subscription, so why wouldn't I do my family fun party games, word puzzles, etcetera, with my Netflix and my phone? Uh,
And that generally changed how you view shows, right? I mean, a lot of times now people have their phone in their hand while they're watching shows. So it's not a
I
far step to say, why not also play games through Netflix on your phone at the same time?
so I kind of hate that. They design shows knowing that you're also on your phone at the same time. So they're, like,
Yeah.
repeating things throughout the show. So I hate that as someone who, like, cares about the art of TV shows and movies, but
Yeah.
as someone who understands tech and algos and how things work, it makes sense, right? You repeat things 50 times because the person is vegging out on their phone at the end of the night and they have Netflix on the background.
Yeah. I feel like it's not a great thing for the industry, but if it works, they will do it.
All right, where do you have Netflix on our tier list?
For me, it's an A-tier company. I feel like you could also make an argument that in the industry it operates in, it might be S tier. I still say it is an oligopoly. You still have other players with like a lot of IP. So for me, it's an A tier, I would say.
Yeah, I would have it in maybe B tier or A tier just because they do have to spend a lot of money to maintain the business. And ultimately, there is no like switching costs. Like you could just cancel your membership right now. But
That's true, but
I'm fine putting it in A tier here. One other thing that Netflix does really well is that they make shows with big YouTubers. So they'll find a channel that's doing really well on YouTube and then they'll make it into a series on Netflix. And I think that's really smart because they've already validated the demand and then they put it in a way that's better organized and better and vetted so you can trust that it's gone through a quality standard. So again, they're really just on the bleeding edge of doing things like that. And
it's
again,
also in,
Amazon did that with Mr. Beast and Beast Games as well. So I
yeah.
mean, Amazon's another player there.
It's also interesting because technically those are shows that, depending on the quality that you produce them, they are certainly cheaper and people like those shows. So if you have plenty of those shows, you could also see that you have huge hits making a lot of money with shows that cost less money than, some of the big ones that you put out. So probably it's a net positive overall, even though once again, for the art of the shows, it's not that great. I don't like to watch those.
Yeah, fair enough. All right, we got two left here. Airbnb.
I think Airbnb is a company that a lot of times people say, why not own Booking.com? Because it's one of their main competitors and it's performing pretty well, probably better than Airbnb to some extent. I would argue with the moat now. Booking.com historically always had to pay this what people call Google tax, so that they show up in the search results pretty early and then people go on Booking.com side. It's different for Airbnb. Airbnb is a brand in itself. You saw that when they reduced ad spend, for example, while COVID happened, 90% of people came back to Airbnb after without spending all that money on advertising. You wouldn't see that with most other players in that space. And that makes Airbnb special to me. So I feel like they have a lot going for them. They also have these alternative recommendations that are still not yet on Booking.com, on Verbo, and a lot of these other sites. So most of them you can only book on Airbnb, which is to me also a competitive advantage. Why is that happening? Because a lot of times when it's not yet a professional host, they don't want to go through listing it on Booking.com, listing it on Verbo, listing it on Airbnb. They mostly want to, they have this rental, they want to put it out there. They know network effects. Most people are on Airbnb, so they put it on there. The risk there is the more professional hosts you get, the less that mode will still be there. You also have regulatory hurdles, where in a lot of cities, you talk about Barcelona, talk about New York City. I also heard that there are a lot of problems in Canada. Airbnb is under some scrutiny. Same is true for the other company that we have left with Uber. I do think the product is so good. I personally have only used it for like the last 10 years that I think it will survive that. But I do think there's a risk.
Yeah, so a few things with Airbnb. You mentioned the regulatory risk. There's also kind of like the multi-homing where hosts do post on Airbnb booking and VRBO simultaneously.
Exists, yeah.
The other thing that worries me is like they have this core business and everything they've kind of tried since then has not really landed. So they haven't actually taken advantage of their optionality. And I am probably less of a fan of Brian Chesky than most. He comes across as like, hey, I'm really design obsessed and I like Steve Jobs and but it feels like his strategy and his vision are kind of all over the place. And it feels like someone who is trying to act like they're Warren Buffett because they've read some books, but they don't naturally they're not that person. So there's just something off with him that I feel like this is a they have a good space in one thing. I think they'll continue to do that. And I think they'll continue to fail on all their future bets.
I think it's still a young company. I think the last time they tried experiences and services, it was kind of killed by COVID at some point where they thought like, okay, we got to stop this. And now they give it a second try. I also don't think it's yet as successful as they hoped for. Otherwise, they would also talk about it either more, but also they would report it as a standalone segment, which is not what they currently do. They have it in nights booked, which is not a good sign necessarily. I do think they changed the approach to or how to approach the customer basically. So instead of being a or making it its own product on the app, it's now integrated into the general process. Now, this sounds like a small thing. I don't think it is. I think it like if you're on the Airbnb app, we talked about it with PayPal to some extent. Like, how much time would you actually spend on an app like that? Not a lot, but you're certainly going through the booking phase. So if you do that and you immediately have the experiences and the services in there, I think there's a chance for that being a good business. And it also takes scale. If there are only like, let's say a dozen experiences that you can book, chances that you find something that actually interests you are pretty low. So the more people will use them, it's kind of the same network effect that the overall platform has. The more people who actually offer experiences will also go on Airbnb, and it's kind of a reinforcing loop. And you have to see if that works out or not. It hasn't worked out the first time. I'm not too bullish on it working out now. I think my main bullishness on Airbnb would come from the main business. I mean, you're still highly concentrated in mostly 5 cities or geographies. So you're operating in 190 countries. If you just expand the core business, I don't see how that business alone shouldn't grow double digits for a long time to come. So I think everything extra would be great, might work out in the future, but I don't think you yet have proof of that actually working.
So where do you land on Airbnb?
If I put Copart into B and I look at the companies that we have in A, I would probably be in the B tier. I think it's a great company. I think the network effects also play a role, but I think generally you have a competitive field. We do not yet know how AI will change the process of booking vacations. So I talk about the risk with Booking.com that they pay the school tax. Maybe it's not working for them when most people book through AI anymore, but that's not a given. So I think I see it as a B tier,
Yeah, it's a to me it's just
high
it's
B tier. For
so
you,
I
it's
would
probably
have
C tier.
I'll put it in B tier, but it's somewhere in that high C tier, low B tier for me. I think the core business is fine. I think the reality is I don't think they believe that the core business is the business and they're going to keep trying all these other bets that I don't think are going to pan out. And again, I think I'm less of a fan of Brian Chesky than most. Something about him just doesn't sit well with me where I don't want to say he got lucky because I don't think you could get lucky getting into $100 billion company, but I don't think he sees where the business should go. I think he's trying to be a visionary. Like he talks about Steve Jobs too much. Like he's trying to be Steve Jobs and he's not Steve Jobs.
You would say that Airbnb needs an operator more than a visionary.
I think so. But I mean, he has skin in the game and he's been doing it a long time. I just don't think it's an outstanding business, but it's fine. I think he's spending too much time on what color magenta the logo should be. Like, I think that's where he spends his time.
That's a fair point.
All right, last one here. And this is, it's actually more polarizing than I thought on kind of Twitter and YouTube. And
Really?
that's Uber. How do you
Okay.
think about the Uber business? I think it's polarizing because of Waymo and Tesla and strong
Yeah,
opinions.
that's true. That's true. That's something we felt as well. I actually say that a couple of years ago, I probably agreed that it's more polarizing than it is today. But now you've seen the margin expansion play out in like a magnificent way. It's like a highly profitable company. You have a lot more scale, the network effect of, you have more drivers there. That means you have shorter wait times than with any of the competitors. That means you have more riders. You have more drivers because of the shorter wait times. I feel like the network effect is working pretty well. You have this dual platform where you have mobility and Eats. Both is performing well, even though Eats is not. I mean, you technically have more competition in that space than you have in the core mobility business. I like the CEO. I feel like he's a great operator. I like his vision for the company, and I don't see the AI risk as threatening as probably than a lot of people do. I feel like the more I said AI, AVs, I mean, the more AV players there will be, I feel like the more important Uber's role will become of being an aggregator of demand on their platform. The only risk, not the only one, but a major risk would be that Waymo reaches a scale where they don't need Uber anymore, and they basically they have enough demand on their own website or their own app. But I would also say that you need a whole lot of cost to do that because the demand for Uber, for example, is highly volatile. Like there are certain phases in a day where you need a whole lot of Ubers. So that means you need a whole lot of drivers on the street, and then people will book all of them. And that's okay for Uber because they don't own the cars. But if you're a company that also owns the cars, and then you have to adjust based on the demand. So there are times when, I don't know, an NFL game ends, and then suddenly you need 20,000 cars on the road. But then there are other times where you don't need, any cars on the road, maybe like 500 cars. Where do you store the cars in the meantime? I think there are like a lot of open questions and a lot of, economic questions. It's like, do you want those cars on your balance sheet? With Uber, that's not the case. So I feel like them being in the aggregator position is a good place to be in. But I certainly also see risk there.
Do you see any risks with Tesla long term and allowing their fleet of other people's cars as robotaxis, or do you think that's more pie in the sky, or do you think that it'll eventually happen just later than sooner?
I question the scale of how many cars Tesla will actually get on the road with that. Like you would need millions of cars. That would basically mean that your Tesla must be like a second car, for example, because if you want to get it, like we just talked about the demand. Like if you drive to work, for example, then in the meantime, demand will likely be low because more or less it's a 9 to 5 job. Most people need their car at like 8:30 and then they need it at 5:30. So it needs to be a second car that can be used. Also, there were so many promises made in terms of like the Tesla robotaxis over the last decade that I don't think they will be there to the extent that they could actually replace Uber before Uber becomes this demand aggregator. I totally see why Tesla fanboys would tell me that I'm wrong because they make significantly more progress than I currently give them credit for. But I don't see that as the main bear case right now. No.
Yeah, that's fair. And I mentioned this on another conversation. Tesla's just really polarizing because
Yeah.
of the valuation, because of Elon Musk, because of I feel like they do deliver quite a bit if you look on decades, but if you look on years, it's usually falls flat. So it just makes it hard for us to really assess how they're moving. My concerns with Uber is just who they're competing against potentially long term in Google and Tesla.
Yeah.
Not necessarily the people that I want to be competing with from a AI and autonomous standpoint.
Yeah. I feel
Again,
like
I think it's a good business. I think it could play out the way you're saying, where they just become the aggregator and they are the app. But I think there is some risk that's not how it lands in 10 years.
my co-host and I did a lot of presentations on Uber, and it was split into bear and bull case. And mostly did the bear case. So I know all of those risks, and I do think there are like valid concerns there. And one of them would actually, in my case, also be who you compete with. Like all of the big companies, be it Amazon, be it Google, they have their own cars, like their own AVs. Currently, they are still using Uber and their platform. That might not be the case. Again, like Waymo is obviously the closest to having the scale where they wouldn't need Uber anymore. Currently, they're all still using Uber and their app, and I would go back to the point that I made about Mercado Libre and the opportunity cost at companies like, Microsoft, Amazon, Google. The amount of work it would take you to deliver the same type of network and overall capability that Uber has. I'm not sure that companies like Amazon, companies like Google want to spend that money and that time when they can spend it on something else. If they can just, the alternative is you plug your Waymos into Uber, you plug your Zooks That's basically the cost of Amazon into the Uber network. It might happen at some point. I don't necessarily see that as the most likely scenario, but it's a possible one.
Okay. So where do you land on Uber?
Gosh, it's a difficult one. I actually like when you just look at this list, I'm just looking over it and think like, did we do any drastic mistakes? I think currently it all looks
We can change them if you want. If something's
I think currently
sticking
it
out.
looks yeah, it looks quite okay. And if I'd look at these companies, I would probably say Uber should be I would also say between A and B tier. You could make an argument for B tier, probably the similar with Copart, where you say, well, if you think about risks 20 years out and you see the biggest risks materialize, like what would the Uber business still look like compared to some of the other businesses? And then say, well, maybe similar to Copart. So I would say A tier or high B tier, depending on where you want to put it.
Right. I'm gonna put it in high B tier for you here. I don't think it's quite at the same level as the companies in A
Yeah,
tier from a risk standpoint, but I think Uber is a better business than Airbnb, like by a
yeah,
decent amount.
fair point.
So that's our list, 15 companies. Is there anything you want to change? Oh, and one thing I'll mention is when it comes to valuation, I think Uber is like very reasonably priced from what it
Yeah,
seems like, right? So I think some of the risks we're talking about are baked into the price. And that's giving, if you don't believe those will pan out, you're getting Uber at a good price right now.
yeah, maybe that's one thing we should mention at the end here now that this is basically not a list by which company we would currently buy. Like it's a quality rating, and then you have to figure out like, okay, what's the valuation on these companies? Which one would you own? So just as you said, I think Uber is valued pretty reasonable. Lululemon is valued pretty cheaply, and then you have other companies that we put in A or S tier, which are more expensive, but we also think the quality is higher. So those are considerations that you have to do. But if I'm looking at this list, I think I'm pretty okay with it. There's no company that's immediately jumping into my eye thinking like we misplaced this one.
Yeah, I would agree. And the one thing I'll also say is like position sizing, right? So let's say all of the
Totally.
companies got cheap. The ones that are in S and A, I would be more comfortable making them large positions. When the
Yes.
stuff in C and D, they're more bets to me. And that's how I would kind of look at this. Like there's no price where I'm buying 50% of my portfolio in Duolingo or PayPal. Like there's just no price that
100%.
fits, right? But if Amazon got cut 2/3 or Hermes, it's something that you would have to consider. And I think that's how I'm thinking about how this has landed.
I totally agree. Like on our show, when we talk about our actual like investments and how we think about investing in these companies, position sizing is a huge thing. Like most of the people just listen to episodes and feel like either a company is a buy or a sell. But a company could be a buy and it's a small buy. Like for example, chapters, like when we decided to buy it for the portfolio, it was a 1% bet because it's like it's a speculative bet. You want to keep an eye on that company. And usually we don't do 1% positions except for it's actually a moonshot. Otherwise it's larger. But I do still think that there are companies where you could say, I buy them, but your risk management isn't the position sizing. And that's the case with a lot of these companies. And as you said, like as A tier, when I look at those companies, most of them, if they sell off, there's a good argument to make that you can buy a good chunk of those businesses.
Yeah. Like if you want to buy 2% of your portfolio and Duolingo, 3%, I think that's totally reasonable. But if you want to make it 40%, you really need to have a good thesis and be able to monitor it.
Totally agree.
Awesome. Daniel, thanks so much for your time. I think this was hopefully useful for the audience, really in depth. Where can everyone find you?
Well, as I said, like we do deep dives weekly for the Investors Podcast, and we also like all of these companies we have deep dived. You will see some of them in our portfolio as well. So yeah, if you want deep dives, we spend about 40 hours per episode on the research. You should check that out.
Awesome. Thanks for your time. I really appreciate it.
Thank you for having me.